Today, we're doing a complete breakdown of Indian Accounting Standard 110. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Companies once hid behind legal ownership, but Indian Accounting Standard 110 redefined control. Imagine owning just 40% of a company, but still controlling it. This standard clarifies how businesses consolidate financials, ensuring transparency. By the end, you'll grasp how control, not ownership, drives consolidation, impacting group financial statements. Indian Accounting Standard 110 revolutionized financial reporting by emphasizing control over mere ownership. Previously, firms improperly consolidated entities based solely on legal ownership percentages. This lack of clarity led to misleading financial statements. The standard introduced a control-based approach, ensuring entities that truly control others consolidate them, reflecting accurate economic relationships and fostering transparency. Understanding this change is crucial for grasping how financial statements now provide a more truthful business picture. From April 1, 2016, any company using Indian Accounting Standard must apply Indian Accounting Standard 110. The key requirement is consolidating entities based on control, not ownership. Control involves power over decisions, exposure to returns, and the ability to influence those returns. For instance, even a 30% stake might require consolidation if control is evident. This shift ensures financial statements accurately reflect the economic reality of business operations. The control model under Indian Accounting Standard 110 focuses on three pillars: power, returns, and influence. Power could come from voting rights or contractual arrangements. Returns involve any economic benefits you're exposed to from the investee's performance. Lastly, influencing returns means active decision-making capacity. This model matters because it prevents mere passive ownership from dictating consolidation, ensuring that only those with true control reflect their influence in financial statements. Understanding the scope of Indian Accounting Standard 110 is crucial because many candidates forget that investment entities measuring subsidiaries at fair value are not covered by this standard. That's a classic interview trap. Knowing exactly what is included and excluded can make or break your understanding of consolidation requirements. Indian Accounting Standard 110 applies to any company required to prepare consolidated financial statements. If your company controls another entity, this standard mandates consolidation. This ensures a complete picture of the group's financial health. Even entities with joint control must evaluate their position under the control definition to decide on consolidation needs. Some entities are explicitly excluded from Indian Accounting Standard 110. If a company doesn't control another, it's not consolidated. Investment entities valuing subsidiaries at fair value are exempt. This distinction prevents incorrect application of the standard, ensuring clarity and accuracy in financial reporting. Avoid over-consolidation. Knowing these exclusions helps maintain the integrity of financial statements. The term parent in Indian Accounting Standard 110 refers to any entity controlling others. This control involves directing another entity's financial and operating policies for benefit. Imagine a multinational with subsidiaries worldwide. It's the parent. Accurate identification of the parent ensures proper application of consolidation rules, providing a clear and thorough financial depiction of the group. A subsidiary under Indian Accounting Standard 110 is an entity controlled by another, known as the parent. This control involves managing financial and operational policies to derive benefits. Consider a domestic firm wholly owned by a foreign entity. It's classified as a subsidiary. Proper identification is crucial for accurate consolidation, reflecting the true economic reality of the group. Edge cases often trip up finance professionals. If a holding company lacks operational power, Indian Accounting Standard 110 may not apply. Joint ventures require careful assessment of control. Venture capital firms with influence but not control might not consolidate. Temporary control loss doesn't necessarily exempt a parent. Recognizing these scenarios ensures adherence to the standard and avoids consolidation errors. Imagine a world where businesses could obscure their control over subsidiaries, leading to misleading financials. Indian Accounting Standard 110's control model eliminates this by defining clear steps to identify parent entities and consolidate subsidiaries. This ensures transparent financial reporting and shows true control over assets, safeguarding stakeholders' interests. The control model is the backbone of Indian Accounting Standard 110, ensuring accurate financial consolidation. We'll track Meridian Corporation's $10 million SaaS contract with Acme Incorporated, focusing on how each step from identifying the parent to eliminating intergroup transactions serves to present a clear picture of financial control and performance. To start, we identify the parent entity by examining who holds the decision-making power. Meridian Corporation's $10 million contract with Acme Incorporated highlights this, as control isn't just about ownership, but strategic influence. Missteps often occur when assuming majority ownership suffices. Indian Accounting Standard mandates considering both rights and potential returns. By identifying Meridian Corporation as the parent, we set the stage for consolidating group financials. With the parent determined, we now identify subsidiaries. Meridian Corporation exercises control over Acme Incorporated through its strategic decision-making rights, making Acme a subsidiary. A common pitfall is ignoring contractual rights, which can skew classifications. Indian Accounting Standard emphasizes evaluating influence through these contracts. Acme Incorporated is now confirmed as a subsidiary, setting up consolidation of their financials. Assessing control is about the parent's influence over a subsidiary's key operations. Meridian Corporation's strategic influence, as confirmed in the second step, illustrates this with Acme Incorporated. A frequent oversight is focusing only on financials, overlooking operational direction. In compliance with Indian Accounting Standard, control is verified through the capacity to direct crucial activities. This solidifies Meridian's full control, readying us for consolidation. Now we consolidate. Merge the financials of Meridian Corporation and Acme Incorporated after confirming control over Acme's operations in Step 3. Common pitfalls include failing to eliminate intercompany balances, skewing financial accuracy. Indian Accounting Standard insists on presenting these as one economic entity. With consolidated financials, Meridian's true financial position, including the $10 million contract, becomes clear. Finally, eliminate intragroup transactions. For Meridian Corporation's $10 million SaaS contract, this means removing all internal dealings with Acme. Post-consolidation from Step 4, failing to adjust these can artificially inflate results. Indian Accounting Standard requires complete elimination to avoid misleading financials. With these adjustments, Meridian's consolidated statement reflects accurate economic reality, maintaining integrity and clarity for stakeholders. Selecting the right measurement method directly shapes your financial statements, affecting asset valuation and liabilities. A misstep can lead to significant misrepresentation, impacting stakeholder trust. Learn how to navigate Indian Accounting Standard 110 to keep financial reporting both accurate and insightful. Initial recognition under Indian Accounting Standard 110 demands accuracy from day one. Control is recognized on acquisition date, not before. Assets and liabilities must be measured at fair value, setting the stage for future reporting. Non-controlling interest can be tricky, measured either at fair value or as a share of net assets. Goodwill is a unique beast. Always test for impairment, never amortize it. These choices dictate your group's financial health. Subsequent measurement demands vigilance. Keep assets and liabilities at fair value, adjusting through profit or loss. Goodwill is your barometer for market changes. Watch for impairment triggers. Deferred tax liabilities shift with enacted tax rates, influencing your balance sheet. Contingent consideration isn't static, it fluctuates with contract terms and external factors. This dynamic process keeps your financials relevant and reliable, guarding against potential overstated values. Financial statement presentation under Indian Accounting Standard 110 is precise. Your balance sheet displays net assets and goodwill distinctly, clarifying ownership components. The profit and loss must split profits between the parent entity and non-controlling interests, ensuring clarity. Detailed notes reveal acquisition costs and consideration fair value, offering transparency. Classification isn't haphazard, It follows a hierarchy. Consistency here isn't just best practice, it's mandatory for clear communication with stakeholders. Disclosures under Indian Accounting Standard 110 aren't just checkboxes, they're vital insights. Clearly outline your group's structure, subsidiaries, and principal activities. Investors must see the whole picture. Changes in structure, such as acquisitions or disposals, need clear explanations as they impact comparability. Fair value methodologies and assumptions must be transparent as stakeholders assess asset values critically. Detail non-controlling interest calculations, revealing both proportionate and fair value methods, ensuring nothing's left in the dark. A CFO dealing with a $10 million acquisition can't afford to misstep. Every asset's fair value measurement must accurately reflect on the balance sheet. Goodwill isn't just a line item, it's a focus area for impairment as market dynamics shift. Transparent disclosure of group changes is non-negotiable, securing stakeholder trust. Deferred tax rate changes require immediate financial model adjustments, ensuring financial projections remain grounded in current tax realities. This is the CFO's world under Indian Accounting Standard 110. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Discover how Indian Accounting Standard 110 guides the recognition and measurement of their $1,200,000 investment, impacting balance sheets and profit statements. Investing in a subsidiary demands meticulous accounting under Indian Accounting Standard 110. Meridian Corporation debits investment in subsidiary and credits cash for $1,200,000. This aligns with recognizing control over the subsidiary, marking a significant asset addition to their balance sheet. Such investments reflect strategic growth ambitions, reshaping the group's asset composition. Indian Accounting Standard 110 mandates the consolidation of a subsidiary's assets and liabilities. Meridian Corporation recognized $800,000 in assets and $300,000 in liabilities. This consolidation ensures accurate representation of financial health, giving stakeholders a clear view of total resources and obligations. By integrating these figures, Meridian enhances transparency and accountability. Eliminating intercompany transactions is vital to avoid overstating financial results. Meridian Corporation debits revenue and credits cost of goods sold by $100,000. This adjustment reflects true economic activity, ensuring reported earnings are not artificially high. Following Indian Accounting Standard 110, such eliminations maintain transparency in consolidated statements. Indian Accounting Standard 110 requires recognizing non-controlling interests to reflect minority ownership in financial statements. Meridian Corporation debits non-controlling interest and credits equity with $210,000. This entry ensures stakeholders understand shared ownership, presenting a thorough view of equity distribution and its impact on financial strength. Adjusting for depreciation is crucial for accurate financial reporting. Meridian Corporation records $50,000 as depreciation expense, matching asset usage over time with financial periods. This adjustment aligns with Indian Accounting Standard 110, ensuring assets are not overstated while affecting net income and asset valuation, providing a realistic financial snapshot. Dividends to non-controlling interest recognize their right to profit sharing. Meridian Corporation debits retained earnings and credits cash for $30,000. This transaction, guided by Indian Accounting Standard 110, reduces equity and cash simultaneously, reflecting a responsible return of capital to minority investors, maintaining stakeholder trust and financial transparency. Upon disposal, Meridian Corporation records a cash influx of $1,300,000, while derecognizing its investment in subsidiary at $1,200,000. This transaction under Indian Accounting Standard 110 results in a $100,000 gain, impacting financial performance and liquidity positively. The move showcases strategic reinvestment capabilities, enhancing financial flexibility for future ventures. Every Big Four and investment bank interview on Indian Accounting Standard 110 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Control under Indian Accounting Standard 110 is the power to govern financial and operating policies for benefits. This isn't just majority voting rights. It includes power over key decisions, exposure to variable returns, and ability to affect returns. A common mistake is thinking control is only about ownership percentage. Remember, control means having the power and the ability to use it. Indian Accounting Standard 110 mandates consolidation to reflect the economic reality of control. It ensures financial reports present the entire group's assets and liabilities as a single economic entity. This provides clarity and comparability for investors. The error to avoid: treating each subsidiary as separate. Consolidation aligns reported figures with actual control and economic interests. When recording an acquisition, Indian Accounting Standard 110 requires determining fair value of identifiable assets and liabilities acquired. Goodwill or gain from a bargain purchase is recognized. Use the acquisition method, focusing on control transfer date. Missteps often involve ignoring fair value adjustments. Accurate valuation ensures aligned financial reporting with acquisition realities. Eliminating intra-group transactions prevents inflation of revenues and expenses, showcasing the group's true financial performance. Such transactions don't reflect external economic activities. Forgetting elimination distorts actual figures. Indian Accounting Standard 110 ensures transparency and accuracy, presenting genuine operational results, not inflated by internal dealings. Memorize: intra-group equals no real economic impact. Indian Accounting Standard and International Financial Reporting Standards both emphasize control, but nuances exist. Indian Accounting Standard may have more detailed guidance on specific transactions. Differences might arise in definitions, disclosures, and transitional provisions. Avoid assuming identical treatment. Know the specific requirements of each standard to ensure compliance. Always compare and contrast for precise application. Both frameworks focus on power, returns, and the ability to affect returns. However, Indian Accounting Standard might align more closely with local regulatory nuances. Key differences can influence control assessment, impacting consolidation decisions. Be cautious of assuming identical definitions. Understanding subtle variations ensures accurate financial reporting and compliance. In consolidating a 75% owned subsidiary, control is established. Consolidate assets, liabilities, and NCI at fair value. Align revenue and expenses, eliminating intragroup amounts. The challenge: accurately calculating NCI and goodwill. Missteps in valuation can skew financials. The takeaway: focus on precision and adherence to Indian Accounting Standard 110 principles for clarity. Investment entities typically exclude subsidiaries they control from consolidation, focusing instead on fair value measurement. This exception aims to reflect investment performance. The trap: misunderstanding exclusion criteria can lead to incorrect financial statements. Key insight: not all controlled entities are consolidated. Know the rationale to avoid pitfalls. Disclosures under Indian Accounting Standard 110 include information about significant judgments in control determination and financial effects of changes in ownership interests. Common errors arise from incomplete disclosures. Accurate, comprehensive disclosures ensure transparency and provide investors with insights into control dynamics. Remember, clarity and completeness are crucial for effective communication. Potential voting rights, like options, influence control assessment if substantive. Indian Accounting Standard 110 focuses on current capability to direct activities. The trick: assuming potential rights always equal control. Incorrect assumptions can mislead consolidation decisions. Key takeaway: assess substance over form, focusing on actual control implications, not just potential. Understanding Indian Accounting Standard 110 begins with recognizing its core purpose: to guide consolidated financial statements for groups. It focuses on the concept of control, defining it through power over investees and exposure to variable returns. Power involves rights that direct crucial activities, while variable returns fluctuate with performance. The link between power and returns solidifies control. Knowing these definitions and scope is vital for grasping the standard's application. Indian Accounting Standard 110's control model requires continuous reassessment, considering potential voting rights in control evaluations. Subsidiaries, including those for disposal, must be consolidated. Non-controlling interests can be measured at fair value or via net assets. Goodwill recognition follows business combinations, while uniform accounting policies across the group are a must. Exclusions from consolidation occur if control is temporary or severe restrictions exist. Mastery of these rules ensures precise application of the standard. Prepare for interviews by understanding key control traps such as misjudging potential voting rights. While Indian Accounting Standard aligns with international financial reporting standards, nuanced differences exist. Know the critical disclosure requirements, especially around non-controlling interests. Judgment is crucial in complex ownership scenarios, affecting metrics like leverage. Practical expedients are limited. Thorough analysis is essential. Continuous monitoring of control factors ensures compliance, making these insights vital for both application and discussion in professional settings. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.